Okay, so chapter 8 is all about receivables. The good thing about chapter 8 is there's some information in here that is going to look familiar to you, which is a nice thing to get at this point since you've had so much new stuff in the last couple chapters. So there is some stuff that's going to look familiar to you. However, there is also going to be some new stuff in this chapter. So you're going to get a mixture of both things in this chapter. We are going to be looking at different types of accounts or different types of receivables. And that's like a brief kind of overview of the different types of receivables. We're then going to spend some time looking at accounts receivable and recognizing accounts receivable. You've already done that and you just didn't know that that's what it was called. So we're going to be going over that. And then we're going to go over valuing accounts receivable, which is a brand new concept, brand new thing, different than anything you've ever done. We will then look at notes receivable. And with notes receivable, there's a lot of new stuff in there. They'll be determining maturity dates. They'll be computing interest, recognizing the notes receivable, and disposing of the notes receivable. We'll also look a bit at how the financial statement is done, and then we'll talk a little bit at the end. Today's Wednesday. Sorry, I have the hiccups. On Monday, and we will talk about. We'll get into the notes on Monday, and we'll talk about the statement of presentation, and we'll also look at the managing receivables on Monday. So today we'll just be covering the accounts receivable part of the class. So when we talk about receivables is money that we are going to be receiving from our customers at a later date. So we have already provided them with the accounts receivable works is that let's say that you own a bread company. Oh, hold on a second. Okay, just so you know, my internet is unstable. I have a new router box that's coming. So if I cut out, please bear with me. I will repeat what I just said because my internet is kind of up and down. So, okay, so you've already dealt with accounts receivable. So all receivables are used because we've provided a service or we've provided a product or both to a customer and they haven't paid us yet. So we are going to be receiving that money later. Now, up to this point, we have really dealt with accounts receivable. And the way accounts receivable works is it is what they call revolving credit. It's almost like a credit card in a way. So what happens is if you are a company, let's say you're a bread making company, and you sell different types of bread. So you need to buy flour to make your bread. So in order to buy the flour, what you would do is you would go out and you would go to different flour producing companies and you would say, hey, I'm a bread maker. I need to buy X amount of flour every month to make my bread. And they'd say, okay, do you want to pay cash or do you want to open up an account? So if you open up an account, what you would be doing is you would be applying for credit. They would approve you for a certain amount of credit. And then you would buy flour and then you would pay your bill, buy flour and pay your bill. And as long as you were paying your bill within their terms, remember we've looked at terms already, within their 30 days, then and you stay under your credit limit, then you're able to continue to buy flour. Now for you as the buyer, that would be accounts payable, right? And we're going to be looking at accounts payable later, which is the other side of accounts receivable. But accounts receivable would be that you're the flour manufacturer. You're the flour manufacturer, and so you manufacture all kinds of different types of flour, and people that have bread companies come to you and buy flour from you. And instead of them paying you cash, you extend credit to them. So you let them take the flour with the promise to pay later. And all of your accounts have different credit limits based on their credit worthiness, which is the whole process of determining what people are able to pay. And so you bill them every time you provide them with flour, okay? A credit card works exactly the same way. You've been approved for a certain amount of credit and or you approve your customers. Like if you were Macy's, you would approve your customers for a certain amount of credit and they could buy up to that credit limit as long as they stayed within their credit limit and they were paying their bill on time. Now, a note is something that's very different. A note is unique to each purchase. So every time a purchase is made on a note, it's a process of negotiation and a process of signing a new note. So a note is often for big ticket items, and a note is often for things that are one-time purchase kind of things. So if you buy a house, you sign a note. It's a very long legal document with many pages with lots of legal information. If you buy a car, you sign a note, and every time you buy a car, you sign a new note. So each note is for a different purchase. So each time it's done, it's negotiated. So every note's going to have different terms as far as when it's due. You're also going to see that notes have interest associated with them. So there's going to be a different interest amount that you have to pay if you're the buyer, and it's notes payable, but now your notes receivable. So every time you sell something to a customer, you would negotiate a new contract for that sell or a new note. So you would negotiate the timeline, you would negotiate the interest, etc. Okay. All right, so other receivables. We're not going to be dealing with other receivables, but it might be if we make loans to people in our company, or interest or income taxes, things of that nature. But we're not going to be dealing with other receivables in here. We're only going to be dealing with accounts receivable and notes receivable. All right, so receivables often represent a large percentage of the assets within an organization. And this can be a really important part that relates to the financial health of an organization. Because if an organization relies pretty heavily on customers paying them and their customers don't pay them, then the company could potentially go under if people are not paying them. And so this slide here just kind of shows you the difference between what companies have higher percentages in receivables versus other companies. Okay. All right, so accounts receivable. So there's recognizing and valuing accounts receivable. So recognizing accounts receivable, this is what you've already done, and you may not have realized that that was the name. Maybe you did. So in a service organization, we recognize accounts receivable when we provide the service to the customer. Okay. In a merchandising organization, we record it when we provide the product to them. Okay. And again, you've already done that. Now, in the service organization, remember, you debited accounts receivable, you credited service revenue. In the merchandising company, you debited accounts receivable, you credited sales revenue, and then you debited cost of goods sold and you credited inventory. Remember that? How when you sell something in and a merchandiser, you have to have the extra entry. Well, in this chapter, they're actually going to omit the extra entry. So you're only going to have one entry for each type in this chapter. That's not normal, but we're really just looking at the recognizing accounts receivable and not the cost of goods sold and all that part. So here's an example for us. Assume that DoorDash Company on July 1st, 2022 sells merchandise on account to Polo Company for $1,000. Terms 2% 10, net 30, right? Remember the 2/10, N 30? Prepare the journal entry to record this transaction on the books of DoorDash Company. Now, we would debit accounts receivable $1,000 and we would credit sales revenue $1,000. Now remember, if we were working back in the chapter where we were actually doing the merchandise sales, we would have an entry for how much this information or how much this merchandise cost. But we are omitting, that means we're skipping that part of the entry for this chapter only. And we're not going to go back to the entries with the cost of goods sold for the rest of this class. So you don't need to worry about that. But just so you know, you really wouldn't do this in real life. This is just something that we're doing just to kind of, I'm not sure why Wiley did it. And I was going to go through and change all the slides, but they didn't give the cost for everything. And then we'd have to rewrite all the problems and everything. And it wouldn't correlate with the book. So we're just going to go with the skipping that part of the entry. All right. Recognizing returns on account. You've already done this as well. Remember, if you're the seller, on July 5th, Polo returns merchandise worth $100 to Jordache Company. So they're going to debit sales, returns, and allowances $100, and they're going to credit accounts receivable. If it's a return of merchandise, we actually would be putting it into inventory. How we did that, we put it to inventory. But for this chapter, we are actually omitting that part of the entry. We are not doing the cost of goods sold part for any merchandising in this chapter. Okay, the next slide. On July 11th, Jordache Company receives payment in full from Polo Company for the balance due. Now, this is something that should look familiar to you as well. Remember, how do we do this? It's sales, right? I'm going to put it on the bottom of the screen here because I noticed it's not on here. So hold on a second. I'm going to put this on the bottom of the screen. I need a text box. Okay. So this is where we would do sales minus any returns or allowances, right? And that would give us our accounts receivable number. Then the accounts receivable number times the discount percent would give us the discount dollar amount, right? And the accounts receivable number minus the discount dollar amount would give us the cash number. And we did that a while ago. I can't remember what chapter now. So this would be the total sales for this was, actually what I'll do is I'll put it right here for this one. So the total sales for this one would be $1,000 was the sales, right? Minus the return or allowance of $100. That would give us a accounts receivable number of $900, right? We then had $900 times the percentage, which was 2%, was the discount amount for this problem. So that gives us a discount dollar amount of $18 for this problem. And so we would take, oh, I got a 4 up here. How did I do that? Let me change that. So we would take the $900 accounts receivable minus the $18 discount, which would give us a cash amount of $882. And since we are receiving the money, we would be debiting cash for $882. We would be debiting sales discounts for $18, and we would be crediting accounts receivable for $900. Okay, so we've done all this before. This is the part that's just the refresher, repeat of what we've already done. Okay, so let's go down to the next slide now. The next slide on here shows that some retailers issue their own credit cards. You're not going to get anything about this in your homework or the exam. All they're just trying to show you is that a credit card is just a form of revolving purchase or revolving credit. They just give you the plastic to make you feel important. That's all they do. So they're just showing here that if JCPenney was to bill their customer, they would still, who bought something on credit card, they would still be debiting accounts receivable and crediting sales revenue. No difference. And again, we are skipping or omitting the cost of goods sold portion for any merchandise sales in this chapter. All right. This chapter here, don't worry about this. All they're showing is that if you don't pay your credit card on time, they charge interest. They charge a late fee. You're not going to be doing that with the credit cards. The interest you're going to be dealing with in this chapter is with the notes. Okay, with the notes. All right, so we are going to do problem BE82, okay, which is on page 833. So let me get to that. Oh, actually, I'm going to stop the video and then I'll do a separate video for this. Hold on.